What's up everybody, Gen X Dividend Investor here. In this valuable video, I show you what I believe is a surefire way to succeed in the stock market, so I recommend you watch this from start to end. But first I want to wish everyone a happy and safe new year. This is a great time to reflect on anything you can be grateful for, regardless of what's going on in your life. Like maybe you can appreciate that the sun is shining outside and you're alive, or perhaps savor the latte that you drink every day, or be grateful that you're fortunate enough to even have a smartphone or computer to watch financial videos. Most people eventually realize that their health and relationships are some of the most important things in their lives, and purposefully appreciating what you have, rather than stressing about what you don't have, will add years to your life. Okay, so recently I was responding to tweets on X, and across my feed was this post by Unusual Whales that said that the probability of losing money in the SP 500 decreases from 46% to 6% by increasing your holding period from 1 to 10 years per Bank of America. That got me wondering what the least amount of time was that you'd need to be in the market in order to have gotten a guaranteed return when looking over all of history. Like specifically, if you adjusted for inflation and you were reinvesting your dividends, then how long would you have needed to be in the market to have averaged a positive return? Understanding how long that holding period was to have a guaranteed positive return and thus make your financial investment risk virtually non-existent, at least using historical data, sounds pretty darn compelling to me. So I started trying to find the data the tweet was talking about, and I found a site called themeasureofaplan.com, which shows US stock market returns from 1872 to 2022, adjusted for inflation, for someone who is reinvesting their divvies. What we see is that over the last 150 years of the US stock market, 100% of any 20-year holding period would have ended you with positive real returns. Think about how amazing that is. That means that for literally every single person watching this video, if they had started investing in the overall US stock market in any year since they were born, and had kept investing for the last 20 years, and had been reinvesting their dividends, then their average annual return would be positive. That's pretty powerful stuff to realize, especially for people who are too worried to invest in the stock market because they don't want to lose money. And that reality should help give you diamond hands if the markets fall 50% and then proceed to go sideways for 10 years, or however long. Now, a big flashing obvious disclaimer is that just because it's been true in the past doesn't mean it'll be true in the future, but I'd bet you a pretty penny that it'll still play out that way. Of course, if you choose to invest in individual stocks rather than the overall US stock market, then that changes things, and remember that some companies can always go bankrupt. But that data should help you understand why having a long-term investing mindset is critical to achieving long-term success, at least for the majority of people out there. Okay, let's dive into the data a bit. The green bars are years where returns were positive in the US stock market, and red were years where they're negative. So like this big red bar down in 2008 was the crash due to the financial crisis, and these red bars clustering around the year 2000 were the dot-com crash, etc. Over the last 150 years, the average annualized return was 8.4%. The highest return in any year was 53%, which happened in the 1950s, and the largest single year drop seemed to have happened around 2008 in the financial crisis, when we lost 37% once said and done. And there were some intra-year drops that were even larger than that. This chart highlights the biggest market drops in history, and I've personally lived through 3 of the 5 worst crashes ever. And while some people would say that sucks, I think it was actually great for me because it taught me how persisting through tough times is what allowed me to win, rather than freaking out and selling when times are ugly. Lots of things can cause markets to crash, and crashing after a debt-fueled boom time shouldn't be surprising. One reason I don't use debt to invest is because I've seen how crashes are often even worse if people have purchased using margin. Of course, that's not true for everyone. In fact, one of my friends who worked at a big financial firm did quite well shorting the market before the dot-com crash, and that big win allowed him to eventually leave his company and start his own wealth management practice. He's someone who thinks that people are foolish to not get out of the market when things look bad, and he's the ultimate market timer. And rich people pay him buku bucks to manage their portfolios, and I'm talking about 8-figure plus portfolios. Yet fascinatingly, when I asked him how his returns have been over the decades, he said he probably averages about the same as the market. So think about that. These big whales are paying him much more than they're paid to just own VTI, and they're effectively getting the same results. Crazy. Anyway, take a look at this distribution graph of 1-year total returns. It says that about 69% of stock market years have been positive, which means about 31% have been negative, thus we have more bull years than bear years. 2 years had returns of over 50%, 3 years had returns in the 40% to 50% range, 11 years were in the 30% to 40% range, etc. On the red side, we see 0 years had more than 50% losses, and in fact 0 years had 40% plus losses, but there were 5 years that were 30% to 40% down in terms of real returns. But now check out what happens when we look at periods of time longer than 1 year, where you'll find the annualized return percentages come closer together between minimums and maximums. Like this graph represents rolling 5-year periods. So whereas the 1-year period returns varied significantly from negative 37% to positive 53% per year, now the minimum annualized return improves to minus 11.7% and the max return is lowered to positive 28.5%, with the average annualized return being 7.2%. Or look at rolling 10-year periods. Now the minimum annualized return would be minus 4.1%, with the maximum coming in at 17.6%, with the average annualized return being 6.9%. Okay, now take a gander at the rolling 20-year periods. What we see is that the minimum annualized return is no longer negative, and it's actually at a positive 0.5%, and the max is at 13.2%, with the average being at 6.6%. Thus, the point is that if you'd held on to the total stock market for 20 plus years and were reinvesting dividends and even adjusted for inflation, then all periods in time would have allowed you to average a positive return. Long-term mindsets win. It's pretty crazy that it's historically been impossible to lose with a long-term mindset, though of course you might have done better investing in something else. Anyway, that's why people say it's about timing the market, not timing the market. The data just proves things out. But staying long is easier said than done. I mean, I've seen people who invested for years only get rattled out of the markets when things crash hard. Heck, even on my channel I see people trolling when stocks slump for a while, which simply tells me that they aren't investors, or maybe that they're dividend haters. It's always easier to be an investor when things are going up, but sideways and down markets cause weak investors to fall by the wayside, leaving the true investors continuing on. One of the things I love about quality dividend companies is that they keep paying out even when markets have crashed, and their true passive income, turning otherwise unproductive stocks into cash-flowing assets. Each dividend stock is a fruit tree, and good ones keep bearing fruit and slowly your orchard keeps getting bigger and bigger over time. Yet unlike farming, you don't have to worry about actually doing any manual labor. And another thing I love about dividends is highlighted in this research from Ned Davis and Hartford funds, showing that dividend-paying stocks that grew their dividends over time have had the highest returns coupled with the lowest risk, aka beta. I've shown you this before, but I've got some new subscribers, so it's worth resharing, and specifically they looked at returns in the S&P 500 over the last 50 years and found that companies that had hiked their dividends or that started paying dividends averaged 10.24% returns along with only a 0.88 beta. The category of companies that performed next best were any dividend-paying companies, which average a 9.18% annualized return and 0.94 betas. After them were dividend-paying stocks that didn't increase nor decrease their dividends, which average a 6.6% yearly return. Next up were companies that didn't pay dividends that only average a 3.95% return, and the worst performers were companies that cut or eliminated their dividend, which had a minus 0.6% annualized return. Though remember, there are always edge case companies that won't fit these averages. So yes, dividend-paying companies have outperformed companies that didn't pay dividends in multiple stock markets around the world when looking over longer time frames. However, that doesn't necessarily mean you should avoid non-dividend paying stocks. I mean, I only invest in dividend-yielding companies these days since I'm retired and I want the passive income that dividends give me, but most people should simply invest in great companies, dividends or not. In my opinion, people should invest in companies like Amazon and Google and Berkshire Hathaway and such, because I'm betting they'll continue to outperform over the long run. I think that part of the reason why dividend companies have outperformed non-dividend companies is because companies that end up paying dividends are the ones that have been around for a long time, and companies that have been around almost always end up paying a dividend, whereas companies that go under tend to be newer and smaller companies. But it's not the dividend itself which causes companies to outperform. Instead, I think it's merely because companies that last usually end up paying a dividend. Hopefully you understand the nuance there. Of course, some of us, like myself, do indeed target dividend-paying companies for the majority of our investments, so that focus also gives dividend payers some tailwinds. Okay, and then here's another view of US stock market returns broken out by decade, which helps make the case for how dividends can help you win. We see each decade from 1880 to 2022 with annualized returns listed out. So like from 1880 to 1889, price return, aka stock price return, without dividends, average only 0.8% per year. But when you added dividends in, then you would have made 6% per year. They found the total annualized return in that time frame to be at 8.3% because inflation counted for 2.2% of the return each year. And when looking over the whole 142-year time frame, they found that stock prices appreciated by 4.6% per year on average, while dividends accounted for an additional 4.5% of your return, with inflation being 2.1% of the return. So your total real inflation-adjusted return averaged out to be 6.8% per year over the last 150-ish years. That helps speak to the importance of dividend-paying stocks and why good dividend stocks should be part of your portfolio. Sometimes the best performers are low yielders, like how in this decade we saw huge performance from Nvidia, Broadcom, and MasterCard. And some low yielding stocks I'm long in, like Apple and Microsoft, also did quite well. But non-dividend stocks like AMD and Tesla also did incredibly well, which is why I say that most people should invest in what they think will grow, dividend or not. And while it's newer and smaller companies that tend to fail, the unfortunate reality is that big companies can also fail. For example, a recent study by McKinsey found that the average lifespan of companies listed in the S&P 500 was 61 years in 1958, but in 2016 it was less than 18 years. So as time goes on, companies are lasting less and less. In fact, that 2016 McKinsey article believed that by 2027, 75% of the companies that were in the S&P 500 would have disappeared, i.e. some would have gotten acquired, some might have gone bankrupt, or whatever. It's pretty common to see large companies becoming too bureaucratic, which slows them down and can lead to their downfall. Other reasons big companies fail can have to do with the fact that they have more complexity in them. Complexity which often leads to needing more management, and then they get to a point where they're spending more time managing themselves than they're managing for their customers. Now, McKinsey might have overestimated things, but regardless, that's another reason why simply owning something like VTI is better for the majority of people out there. Part of the reason I like holding my dividend ETFs is because they hold multiple tickers, and given how they work, I'm confident they'll exist for longer than most of the big companies out there. Anyway, hopefully now you understand why and how dividends and a long-term mindset can help you win. By long-term I mean at least 5 years, though really I mean decades. I mentioned 5 because I wouldn't even look at the markets if I needed my investable cash in less than 5 years. But if you go into investing with a long-term mindset, and if you keep putting your money to work, and you keep acquiring good assets, then I'm confident you'll win. Sometimes your stuff won't perform as you'd like, but if your asset base keeps growing, then I think you'll be blown away where you end up. You could be the one that started it all, giving your great-great-great-grandkids a massive financial advantage that you yourself never had. There's no reason it can't be you. And there's no reason why you can't show me your support by hitting that thumbs up button, subscribing if you haven't yet, and clicking that bell notification. Now, I'd normally close things off with a shout out to my newest Patreon aristocrat and kings, but I'm still all sold out. So instead I'll close things off by wishing everyone a happy and safe new year. I sincerely thank you for watching my videos and for leaving comments, and thanks a million for sharing my videos with someone you know. That simple act of sharing a video could materially improve someone's financial future, so consider doing that as well. Oh, and I'm not sure I'll be able to release a video next Saturday since I'm going out of town for a few days, but I'll see what I can do. Regardless, I'd like to thank Seeking Alpha who sponsors me. Consider using my Seeking Alpha affiliate link in the description of this video, as using it often comes with benefits for new member signups. I pitch Seeking Alpha because I value their articles and associated comment sections so much, to the point that I'd literally never buy or sell a stock without first checking what Alpha had on it. And as always, I highly recommend that you join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 76 countries around the world. Thanks for watching, have a happy new year, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.